Ladies and gentlemen, welcome to another episode of the Wealthlab podcast with Scott Jackson and Phil Sproule. Phil, how you doing, mate?
Yeah, well, thanks, mate. How are you?
I am well. Happy Friday.
Happy
So
Friday indeed.
let's kick into it. There is some interesting topics that have been going around the world and that have been people have been talking to us, and I wanted to get straight into them. First thing I wanted to highlight is what the hell do we talk about risk and reward? What does that actually mean when it comes to investing? And I just have one slide. In 1 minute, I'm going to explain it to you. So here's what it is. The type of risk demystified. So what do people actually think risk is? Left-hand side, this is not risk. Variation up and down portfolios. Our portfolios always go up and down. No matter where we are, no matter what we do, we don't have a crystal ball. We do have solutions to put in place a strategy to then help you grow your wealth. But this is not risk. What this is portfolio movements. Risk is capital loss from a permanent perspective. That's losing everything. That's betting everything on the farm, or that's taking risks that are completely outrageous. And in a financial context, that is how I would want you as an investor to think about it. So if you've got superannuation, if you've got any type of investment, it's not will this go down, it's will this go to zero? Because it's probably not going to go down. Certainly if you're working with us, it's probably, it probably will have some volatility, left-hand side of my screen, but it's very, 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 very unlikely it'll go to zero. In the history of our working together, in the history of our occupation, the only times anything that has ever gone to zero is that when you've tried to take more risk than you should be. And that's dealing in probably some pretty iffy financial products. I don't know, Phil, can you think of any financial products where where a proper financial planner has put a client into something that's gone to zero? And I'm not talking like, the edges of the Melissa Caddicks of the world who are not advisors, but like, I'm trying to think of something like that. They're genuinely Ponzi schemes or outright scams. And that's
the
just
only
crime.
things I could ever think of would be something like, Lehman's Brothers or something like that. But if you've seen a financial advisor and you've got a properly built, well-diversified portfolio, you've not gone to zero. You've lost a tiny percentage of your capital because the rest of it's spread around into other stuff.
Correct.
But yeah, I couldn't think of a time where any portfolio that a professional advisor put together would go to zero.
Yeah, correct.
Yeah.
You really can't, because it should be a properly diversified portfolio. It will be exactly that. It'll be split across a bunch of asset classes, and then maybe even imagine it like the Australian stock market goes to zero for whatever reason. Let's say we have a nuclear war. You've still got money in cash. You've still got money in international stocks. Now, yeah, they will be linked, but this is how you should think about it from an investment perspective. And if you do start thinking about it like this, well, okay, as long as my money doesn't go to zero, I can actually take a more comfortable view on things and say, okay, volatility is okay, because over the long term, I know this portfolio is well diversified and will grow. And that's the purposes of something that we can help people with. Stuff like this is crypto. Stuff like this is whiskey barrel scams, is anything related to Facebook Marketplace, investment schemes. Something that's basically too good to be true will almost always end up something like that. That is a true risk. A portfolio that's well built, constructed, unique to you, it's going to be temporary volatility. That's why I got that slide up. Right. That was my how you think about investing. What is that? 4 minutes.
Yeah.
Is there anything you want to add in on there, Phil, that you reckon I've missed?
I just think it's really worth sort of adding as well. If you think about risk, so the risk of permanent capital loss. Okay, yep, that's risk. But then also potentially in a retirement concept or a superannuation concept, the risk of not being able to achieve your goals. And a lot of people just naturally think about, I park my money in cash, there's no risk because I can't lose my money. Whereas, in my mind, for most people, you're actually taking on more risk by doing that, because you're taking on the risk. You're not going to meet your financial goals. Inflation is going to be.
You're guaranteed to miss your goals by doing that.
Yeah.
But you definitely will, because you're being too conservative with your funds.
Yeah. Yeah.
And some people are like, well, I just want to be really conservative. I don't have any capital lost. Well, I can guarantee you're going to miss your goals, because you've got income requirements of 70, 80,000 per year in today's dollars. And you've got $400,000 in super, and you really need that to double. And if you go into a conservative portfolio, the maximum upside of that is bond rates or cash rates. So the maximum upside is 4 or 5%, and the maximum downside is potentially a lot more. Certainly with inflation coming at you.
Yeah, exactly right. Yeah, I thought that was super interesting.
Nice. All right, hit me with your topic.
Yeah, look, I unfortunately didn't save or didn't take a screenshot when I saw this earlier, and I've searched high and low. I'm pretty sure it's been deleted, but I came across this morning a letter that had been sent out by a very large Australian real estate agency. I won't name, but it was
Interesting.
very, very aggressive pitch to sell your house now. It was,
What?
yeah, like bordering financial advice. It was that full on. So they were talking about the upcoming mortgage cliff with all these fixed rates about to come off. Right? Property markets are definitely going to fall. You need to sell your property now if you want to sell, or you're going to miss out.
Whoa.
Like super aggressive language, and it just got me thinking of a few other conversations I've had with people lately. We've spent a lot of time over the last few weeks talking about scams. And in this context, this is not talking about scams. This is perfectly legitimate things, but pitched in a way that's sort of trying to frighten people into action or whatever, or may not be appropriate for the person. So,
So hang on a second. So like I know there's a Four Corners report coming out on real estate, and I mean we dealt with with a real estate agent, and they just lied to our faces. It was unbelievable. Like I could not believe. I mean, like, coming from our industry, right? Of like
yes,
the 12 standards of ethics that we have to pass the
mm,
3-hour exam on, and we have to memorize them, and we have to
yep,
abide by them at all points in time. And every
mm,
time we talk to a client, there is the ethical principles that need to be followed and then proven to our compliance team when they do review the files, which they do very
mm,
often. And we need to be able to quote standard 6, standard 12, standard 1, standard 4 back to the compliance team, confirming that we are complying with the ethics
yeah,
reviews.
yeah,
Mate,
as
this
well,
real
of
estate
course.
agent, this was um they were bragging to me that they'd lied to a potential purchaser.
Yeah, it's amazing. Well, even just you look at all the touched up photos getting around the joint. I went and looked at a house the other day. It looked
Oh,
fantastic
really?
in the photos. I wouldn't put my dog in it.
Oh my
It
god.
was just amazing. But yeah, but what it got me thinking was, and a few things that I've heard from people I've spoken to lately. Like I spoke to someone that was pretty close to retirement. It was suggested to her by someone that she clicked on an ad for that she should be borrowing money, setting up an SMSF, buying a
Oh Jesus.
property to help
Oh
meet her retirement.
Jesus.
Someone less than 5 years from retirement. Now, I don't know what planet that seems like a reasonable idea, because there
Why,
certainly wasn't
Phil?
enough cash.
Tell us why. What's the problem? What's the problem with that strategy?
Well, just a little bit curious as to how we're going to
No,
fund
no.
the retirement income.
Okay, now be
With a
specific. So,
profit, Scott.
let's nail it. So, for example,
Yeah.
what are the problems with this? This is coming
Yep.
back to almost my risk return slide.
Mm,
While there is a potential that now you're putting all your eggs in one basket, so you're actually not
there's
diversified,
that.
right? One
Yep.
problem. Number two is you're borrowing to invest, so you're exposing yourself to rising interest rates.
Yep.
Very difficult to manage a rental property when you've got rent, which is pretty difficult to raise, but you've
Mm-hmm.
got interest rates that can really start moving against you. So
Mm-hmm.
a neutrally geared property can become negatively geared very quickly, which
Mm,
means you need to start putting more money into superannuation, which means you potentially could have contribution cap issues. You could have just cash flow issues because you've got to put more money into your account just to pay the interest.
yep.
And you're also exposing yourself to probably over diversification, under diversification risk of like you probably got a house and another house.
Mm. Yeah,
Prop,
100%.
Property market falls.
And these are problems for anyone going into that type of setup, but they're further compounded by the fact they're only 5 years from retirement. Uh, it depends on who you talk to. Mr. Real Estate Agent this morning with his letter was telling us all the sky's going to fall, whereas any buyer's agent that you speak to at the moment is telling you property's going up, got to buy now, got to buy now. So
All right. I wonder
who knows?
what they're doing on the flip side, trying to get people to buy. Wouldn't it be
Yeah,
interesting to listen to the auctions? Oh, great asset. This is an amazing asset class, blue chip suburb, blah, blah, blah. They love that concept
yeah,
of blue chip.
yeah. But just talking more about the specific situation too, you think that someone's gone into retirement, they've got a property that's not paid off in their super, they're relying on the RET to pay the debt. What's left to start drawing down to fund your retirement income? So, if the client that person had have listened to this person so they're potentially they're in a position where they're going to be forced to sell that property within probably 5 years, entering an unknown market without much of it paid off. It seems like a phenomenally bad idea. So the point of all of this, mentioning that letter, mentioning that is when you're clicking on ads, reading marketing material, any of this stuff, you need to stop and think about what is the person that's written this got to gain. And when I'm saying when this stuff is being posed to you like a news article or like a newsletter or like information, you need to think through to who's written it and why potentially have they written it. And further to that, if somebody's not charging you a fee for their service, because none of us get out of bed and go to work for free, think about that. That they're not there working for free. If they're not charging you, how are they getting paid, and what impact is that having on your decision?
Yep,
Just
and
a bit of food for thought.
it's quite often that if they're making a hidden commission somewhere, it's usually a lot more. It's way higher than if you had been charging or just paid a direct fee.
Absolutely.
So because they are hidden, there's a degree of like opaqueness, which means they need to be offset instead of if you go and see an accountant or you go see a doctor, or if you go and see us, we're going to quote you a fee. We're going to charge you for your advice, and we're going to give that advice to you. All right. If there was a hidden commission somewhere in there, it would need to be dramatically higher for you to work with, say, I don't know, a property spruiker or a crypto guy, or I'm trying to think that what else is sloshing around.
Yeah, that's probably
Whatever it is.
two big ones at the moment.
I'll be honest with you. This is even one that I have come across, but I'll say this quietly. Charity raising. People raising for charities.
Huge one.
There is the between 3 and 6% commissions paid by the charity to people to fundraise. So if you're funneling $1 million into a charity, there is $20,000 to $60,000 of kickback that charity is paying. So I've seen a lot of really ethical looking businesses, B certified type, very, very sort of flowery, very, very lot of pastels used in the marketing, but basically just capital raising for charities and getting undisclosed clips.
Yep. Yeah. If you feel passionate about someone, donate directly.
Yeah, no, bit of a sour note on that one. Let's finish on this good note, Phil. What have you got? How can we finish this on a positive note?
Well, I suppose the positive is that there are plenty of good guys out there doing the right things. And yeah, I just suggest asking a few questions of anyone you're talking to.
I think the summary is don't click on bloody Facebook ads. If you're listening to this, if you're listening to this and you see an ad trying to advertise some type of investment, insert anything, don't click on that. Just don't. It's not going to help you.
Yeah, unless they're qualified financial advisors that are fee for service.
And we're right here. All right, guys. See you next week. Thanks so much.
Cheers.
Bye.